Hello, everyone. Welcome to video 2 for chapter 5. In this video, I'm going to talk more about some of the basic concepts around CCA. I'm hoping by the end of this video, we will get to seeing the basic calculation. So in the next video, we can talk about various classes and start getting through some of those calculations. Right, let's get going. So, when we have a capital property, we have to consider its capital cost because it's from that point that CCA will start. The capital cost means the full cost of acquiring the property. So it's not just the cost to purchase the actual machine, but also the cost of shipping, installation, if there's specific duties. Some purchases might have legal, accounting, appraisal, or engineering fees that are necessary to acquire the property. So these expenses can all be included in the capital cost. The one thing important about sales tax is in Ontario, GST and HST is fully refundable. So since we're going to get that money back, we don't usually include it in the cost of the asset. Now, when you're going through your exercises, we might occasionally give you a PST, a provincial amount. Those amounts usually can't be recovered, so we can include those in the cost. So we look at the sales tax and we say, how much is non-refundable? The non-refundable portion can be added to cost. In this vein, anything that adds back or gives you money back from the cost will be subtracted. Does it go into it? Oh, yes. Um, so government assistance is what I was about to bring up. Sometimes certain government programs will want to support, let's say, manufacturing or processing facilities. And so to encourage people to invest in that sort of business practice, they might provide grants or funding to help them out with their initial investment. So if there is a specific government grant that will help them buy a machine or put money towards building a structure or building for them, then those monies received will subtract against your cost. So if this building costs me $1 million to make, but the government's going to give me $250,000 as a grant, then that will subtract directly against the cost because I wasn't out $1 million. I was only out 750,000. I was out the net amount. Capitalization of interest, elective option to add interest and other financing costs. Um, Acquired to finance construction. So when you're building a structure, it might take some initial funding, and then it takes a while for the building to be completed. So let's say it takes 8 months for your new manufacturing facility to be constructed. So 8 months, we're paying interest on a loan to purchase a property that we can't use. And so you can have the choice to capitalize that interest. But if you capitalize the interest, you're just adding it to the CCA. So you're going to slow down the rate at which you can expense it. For this purpose, most business owners usually just expense the interest as it's incurred instead of including it in capitalization. Non-arm's length transactions, if fair market value was not used, the Income Tax Act can intervene to change capital cost where there's evidence of manipulation. So the government wants purchases and transactions to occur at market value. So if I have a business and I'm thinking of getting out of it and I want to sell, and I have a sibling who says, well, I'll take over that business. And I say, fine, I could have gotten $600,000, but you're my sibling, we're family, I'll give you a break on the deal. That person's cost might not equal the fair market value of 600,000 because I'm giving them a discount. Um, so what the government will come in and they'll say, well, the monies exchanged are between you two, but we are going to assume the original capital cost and fair market value. I'm not going to go too far into non-arm's length transactions. I believe there is a chapter in the future where we go in much further details around dealing with those kinds of transactions. Additions to capital costs. So we already talked about the GST and PST considerations. So HST, paid on acquisitions, is generally refunded, so we're not going to include it in costs. Additions to capital cost, capital versus income. Current expenditures are fully deductible in year. Capital expenditures we add to the capital cost. So what we want to find out is the thing we paid for, does it provide a lasting benefit? Does it improve or create a longevity in the asset we have? Have we made it last longer? Has it improved or enhanced the property? Did we add a new function? Did we expand productivity rates? Can the machine produce more units faster? Does the expenditure add to an existing property or create a separate property? So even if so I was mentioning in a previous video, let's say I have a machine that can print logos on t-shirts. And the existing property is the printer that can print in black and white. If I've modified it, so it can now print in color, that's probably a modification to an existing property. If I take the logo and then put it through a different machine, and that machine can colorize it, then perhaps it's a separate property. In this situation, they might be in the same class. If I have a purchase of a new building, part of that purchase price was for the building, part of it was for the land. So we have the same purchase that actually accounts for two separate properties. So we have to monitor this when we have our purchases, because we want to make sure, A, what we need to capitalize is being capitalized, and two, to make sure these costs are being put into the appropriate class. Determination of current versus capital is a question of fact, and no one criteria is decisive. So for the machine printing, we want to make sure when I change the ink cartridge to allow it to print in color, that's probably a modification that's improving its original condition. But if I'm just changing the ink cartridge, that is a maintenance function. It's a day-to-day transaction. Now, one could argue, well, the ink ran out, the machine's done. I've added a new cartridge, I've extended its lifespan. Not really. That the fact that the ink is spent quickly insinuates that it's part of an overall maintenance. If I put gas in my car, I didn't buy a new car, right? So upkeep is an expected part of most capital property, and trying to decide when is something upkeep, when is it an improvement. Sorry, I keep fumbling my words. But that's the consideration here. So in this chapter, we're mostly going to be talking about capital inclusions to cost and capital expenditures. Now, I mentioned in the primer, for those who have watched it, that I think the half-year rule is where much of the confusion comes from when discussing CCA. The Income Tax Act rules that limit, restrict, or delay maximum CCA claimed in the year the property was acquired. On average, companies purchase assets or properties halfway through the year. Some companies are buying it on the first day, some are buying it on the last day. A lot of other companies are buying assets throughout the year. If we tally all them up and average it out, you have about 6 months of the asset. So the government's not really concerned about the specific day you bought it. You want to keep track in case there's a rule change. For example, this half-year rule was modified on November 28th. So we do want to know the before and after. But generally, we just care the year it was purchased. If it's purchased in the year, it's considered you had that asset half the year. So your first year CCA calculation's going to be half of what it otherwise would be. Only 50% of maximum CCA is allowed in the year the property was acquired. Does it go right into, yeah. So in 2018, the change that happened was the accelerated investment incentive that allowed that 150% of maximum CCA could be taken the first year. In November, they wanted to encourage businesses to add properties, to add machinery. And so they said, hey, new properties purchased, instead of taking half the CCA, you can take, instead of taking minus 50% of the CCA, you can add 50% instead, meaning your CCA is going to be at 150% instead of 50%. The actual wording in the rule was first year CCA is times 3. Give me a moment to go back to our primer. Oh, there's so many. Here it is. So on our CCA calculation, when the accelerated incentive came into place, it was times 3. So what our CCA would otherwise be 6,000, the accelerated incentive said, oh, it's going to be 9,000. So it's increased. This came in 2018. The accelerated incentives last 10 years. After about 5 years or so, the accelerated incentive is being reduced. It's being pulled back to eventually be taken away. So from 2024, the accelerated incentive's gone down to 2. Now we're doubling it. But double of 50% is 100%. So right now, just from 2024 to 2027, the accelerated incentive is kind of undoing the half-year rule. So when the half-year rule applies and the accelerated incentive applies, it's as if they're not even there. So that's the confusion about this. So the accelerated incentive was times 3. Now it's times 2. And after 2027, it will be taken away entirely. And then we're just back to the half-year rule. So that's the consideration that's went into it. So the accelerated incentive begins a reduced write-off over a phase-out period from 2024 to 2027. It allows, for this 10 years it's been in place, it allows that the first year an asset was purchased, we can have an increased expenditure. There's also rules around immediate expensing, the DIEP. This was a temporary rule that's come in place for 2023. It's been extended, but it's a temporary rule in place, and there's no expectation it's still going to be there once you guys are done studying and are out of school. So I'm going to not put too much time or any time at all really into the DIEP. My focus is just on the CCA calculation. Back to our calculation on short tax here. So in my columns, I also have this prorate, this proration calculation. This really applies in the first or last year a company existed. Let's say I start a company, I bought the machines, I've started a company, I want to print logos on t-shirts, I bought the machinery to do it. So it's the first year of the machine. So it would have CCA. At half year. This is my first year. The accelerated incentives times 2, so it's undoing it. But I've only been around, for some reason I can't see my mouse. I've only been around for 200 of 365 days. So in our formula up here, my company started this year, so it only existed for 200 days. So I don't have the CCA for a full year. I have to portion the CCA for how long I was around. So now that 6,000 of CCA has been reduced to 3,287 because I was only around for roughly 55% of the year. So that's what they mean by this short taxation year rule. This rule limits the amount of CCA claimed if taxation year is less than 365 days. The general CCA rates for our classes are assuming 1 full year. So if we don't have the full year, we have to portion it down to the part of the year that it does apply. And we will have an exercise on this later. Available for use rules. I mentioned when we buy the equipment and we're waiting for it to be delivered and it has to be installed and we have to put in inspections, we might be out a certain amount of money. We have a capital cost, it's sitting there, but we're not going to take CCA until it's actually available for us to use, until it's ready to be put into operation. Because before it's ready for use, there's not really anything depreciating just yet. So no CCA is claimed until the depreciable property is available for use or if it's been delivered by year end. So going into available for use rules, the rules for depreciable property other than buildings is when the property is first used for earning income. Let's say something's gone on. I've purchased this machine. It's trying to be installed, but something's gone wrong. Perhaps I don't have certain legal permits or policies in place in order to operate it yet. So it's not quite ready. But I have the machine. So if it's not yet being used, I have until the second taxation year after the property was acquired. So I bought it, a year's passed. Once the second year has passed, the government kind of says, okay, whatever's keeping you from using it, we should start the depreciation process. It's called the rolling state rule. If the day the property is delivered or made available and capable of performing function for which acquired, let's say they finish the installation, it's on the floor. I can be printing t-shirts at any time, but I'm just choosing not to. Maybe my supply is down. I'm still waiting for a delivery. So the machine's ready. It's available for use, but I'm not using it. They don't care. The fact that it's available for use is when CCA can start being taken. Now, remember, CCA is discretionary. So if I choose not to take the CCA, I still can do that. The calculation is just based on when is it available for use. Rules for buildings, the earliest of when substantially all, usually 90% or more of the building used for purpose acquired. So if the building's being constructed, considered acquired to the extent construction completed. Let's say I'm building a manufacturing facility. I have the building complete, the floor is ready, but we're still waiting for some back offices to be finished. Since 90% of the buildings for that function, the manufacturing, I can consider the building as available for use, and I can begin CCA on it, even though the entire building's not fully finished. Again, we have the same second taxation year after year in which property acquired, time that construction, renovation, or alteration completed. So we take the earliest of it. If for some reason construction's been slowed down, we can still take it from the second tax year after we started the process, or once substantially all is finished. Okay. Let's stop this video here because now we're going to talk about classes of depreciable property, and I think I'd like that to be its own video. So thank you for your time. I'll see you in the next video.